The scale ticket said $2.81 per bushel. Dale Renner folded it once, tucked it in his shirt pocket, and walked out of the Kearny County elevator without saying a word to the men still waiting behind him. That was October 1983. Corn was $2.81, and every farmer in that county believed, with the kind of certainty that feels like knowledge but is really just hope, that it was going back to $4. Dale did not believe that. And that difference cost him everything he thought mattered, and saved everything that actually did. Let me explain what was happening in the fall of 1983, because without the backdrop, the math doesn't make sense, and neither does Dale's decision. Farmers in the central Midwest had lived through the late 1970s. They remembered $3.50 corn. They remembered $4 corn in 1980. They had watched prices rise through most of the previous decade on the back of surging Soviet grain purchases and a weak U.S. dollar and the kind of sustained export demand that felt like a new permanent baseline. Banks had lent aggressively against land values that had tripled. Equipment dealers had moved iron hand over fist. Farmers had planted fence row to fence row. The whole structure of rural credit was built on the assumption that commodity prices had found a new floor. Then the floor shifted. Export demand slowed. The dollar strengthened. Grain came back into storage. Prices softened. But most farmers, in the fall of 1983, weren't ready to admit that what they were seeing was a structural change. They thought it was a dip. They thought the spring rally was coming. They had reasons. The analysts on the radio said so. The co-op newsletter said so. The man at the coffee shop who'd called the 1979 run-up correctly said so. So they stored. The plan made simple sense on the surface. Harvest the crop, put it in the bin, carry it through winter, sell it in February or March when the spring rally traditionally pushed prices back up. If you could get from $2.80 to $3.40 or $3.50, you'd cleared 60 or 70 cents a bushel on everything you had. On a big operation, that was real money. That was the kind of money that could cover an equipment payment or reduce a line of credit or just give you breathing room. Dale Renner had 480 acres in production. Average corn yield that year was 112 bushels per acre on his ground. Total production, 53,760 bushels. At $2.81, that crop was worth $151,000 before expenses. At $3.50, it would be worth $188,000. The difference, nearly $37,000, was enough to matter. Enough to wait for. Every farmer around him was waiting for it. Dale was not. Here is what Dale Renner did in October 1983. He called the elevator, locked in a basis contract on his entire 53,760 bushels, and started hauling corn within 4 days of harvest. He was finished by the first week of November. He had the check in his hand before Thanksgiving. He paid off his operating loan, $68,000 at 16.5% interest, and he put the remainder in a 6-month CD at 10.5%. He was done. The reaction in town was not warm. The coffee shop crowd, which had appointed itself the unofficial Grain Marketing Advisory Board of Kearny County, had a clear opinion. Dale Renner had panicked. Dale Renner had left money on the table. Dale Renner had sold his corn like a man who didn't understand his own market. "He got $2.81, somebody said, loud enough to be overheard at the counter. "Spring rally gets to $3.40. He's going to feel pretty stupid about that." Dale heard it. He drank his coffee and didn't argue. Now, before we follow what happened next, let's slow down and do the math that most farmers in that room were not doing. Because the thing about storing grain is that it isn't free. It never was. And in 1983, the cost of waiting was a number most people didn't want to write down. Dale's operating loan was $68,000 at 16.5% annual interest. That's a daily interest cost of roughly $30.74. Every single day that corn sat in a bin or a borrowed elevator space, the interest clock ran. Monthly cost, approximately $935. The commercial elevator was charging $0.03 per bushel per month in storage fees on anything held past harvest delivery. On 53,760 bushels, that was $1,612 per month in storage alone. Add it together. Dale's cost of carrying his corn through the winter to a spring rally was roughly $2,500 per month. That's $30,000 annualized, against a potential $37,000 upside. The margin between winning and breaking even was not $37,000. It was the difference between $37,000 and whatever months of carrying cost accumulated before the price moved. If the rally came in February, the math barely worked. If it came in April, the math was underwater. If it didn't come at all, the carrying cost wasn't a sunk cost anymore. It was a loss, a real, compounding, interest-bearing loss that grew every morning. Dale had done this arithmetic at his kitchen table in late September, before harvest, with a legal pad and a calculator his wife had bought him for Christmas 2 years prior. He wrote down the interest rate. He wrote down the daily accrual. He wrote down the storage fee. He multiplied it out. He looked at the number at the bottom of the page for a long time. His wife Carol asked what he was thinking. He said, "I'm thinking the upside is $37,000, and the cost of being wrong is open-ended." She said, "What does that mean?" He said, "It means if I'm right about $3.50 and it happens in February, I net maybe 20 grand after carrying costs. If I'm wrong, or if the rally's late, I've spent real money chasing a price that might not come." She looked at the legal pad. "So sell it." He sold it. But here is where the story gets complicated, because in December 1983, corn rallied. Not to $3.50, but it moved. Futures pushed up toward $3.10, then touched $3.18 in the first week of January 1984. The coffee shop nearly exploded with self-congratulation. Men who'd stored their entire crop sat a little taller. They said, "See, told you, spring rally starting early." They said, "Dale should have held on." They said, "He's going to be kicking himself." For 2 weeks, Dale was the cautionary tale, the man who'd blinked. He heard it again. He still didn't argue. Would you have argued? If you'd sold at $2.81 and you were watching futures tick toward $3.20, would you have been able to sit quietly in that coffee shop and say nothing? Because that's the first real test, not the market test, the ego test. The moment when being right starts to feel less important than being seen to be right. Dale passed that test, but it wasn't comfortable. Then February came. Export inspections for the week ending February 9th came in at 14.3 million bushels. The trade had expected 22 million. The dollar index had climbed. The Soviet Union, which everyone had been counting on as the buyer that would tighten supply and lift prices, had quietly started sourcing grain elsewhere. Argentina's crop was large. Analysts who'd been bullish in December started hedging their language. The March futures contract, which had briefly touched $3.18, slipped to $3.05 by Valentine's Day. Not a crash, just a slip. Enough to unsettle, not enough to panic. Some farmers sold. Most did not. Most looked at $3.05 and said, "This is a pause. The rally continues. Hold." They held. March came. Corn did not rally. Futures drifted to $2.95, then $2.88. Then, In the last week of March, as spring planting preparations were beginning across the Corn Belt, March corn closed at $2.76. That was lower than Dale's sale price. The men who had stored their crop through winter, who had paid the elevator $0.03 per bushel per month for 5 months, who had watched their operating loans accrue interest through December and January and February and March, were now holding corn worth less than what Dale had been offered in October. They had spent the carrying costs, they had accrued the interest, and the price had gone down anyway. The math at that point was not complicated. A farmer who'd stored 50,000 bushels from October through March at $0.03 per bushel per month for 5 months had spent $7,500 in storage fees. His operating loan, if he'd carried it at 16.5% through that same period, had cost him another $9,000 in interest. Total carrying cost, $16,500. And his corn was now worth $2.76 instead of $2.81. He had not just failed to gain. He had spent $16,500 and lost 5 cents a bushel on top of it. That was the math. Written plainly. No editorializing required. Dale was not crowing about it. He wasn't back at the coffee shop with a "told you so." He was in his fields, doing spring field work on equipment he owned outright, with no operating loan to roll over, with no banker calling to ask about partial payments. That banker call was happening to other people. First National in the county seat had started reaching out to farmers who'd borrowed against stored grain. Not threatening. Not yet. But asking. What's your plan? When are you pricing that corn? What's your break-even? The tone was still professional. But the question underneath the professional tone was, when are you going to pay us back? Because here is something that doesn't show up in grain market discussions, but matters enormously. A stored crop isn't just unsold. It's collateral. It's a leveraged position. If a farmer borrowed $70,000 to plant that crop, and the crop is worth $2.76 a bushel sitting in the elevator, and it's late March, the lender has started doing the same arithmetic the farmer should have done in September. The lender is not emotional about it. The lender has a portfolio to manage. The lender is going to start asking questions. Dale had no questions from his bank. Because Dale had no balance at his bank. He'd paid it off in November. By April 1984, corn futures slipped below $2.70. Some farmers who'd held all winter decided they'd had enough and started selling. Not at the top, not at $3.18, at $2.68. After paying 5 or 6 months of storage and carrying an operating loan at 16.5% for the same period, their effective realized price, the price they'd actually netted once costs were backed out, was something closer to $2.40 or $2.35 per bushel. They had waited 6 months. They had paid storage. They had paid interest. And they had sold at what amounted to 45 cents below what Dale Renner had taken in October. A man named Wayne Pruitt, who farmed the section east of Dale and who had been among the loudest voices at the coffee shop in November, sold his corn in the first week of April at $2.66. He'd stored 62,000 bushels. He'd paid 6 months of storage at $0.03 per bushel, $11,160. His operating note had run at 16.5% for 6 months on a $74,000 balance, approximately $6,100. His net effective price after backing out those costs was about $2.35 per bushel. Against a loan he'd taken out, assuming a break-even of $2.60. Wayne didn't say much at the coffee shop that spring. Nobody brought up the spring rally. Here is the thing that needs to be said plainly. Dale Renner did not predict this. He did not know in October 1983 that corn was going to fall through the winter and stay below his sale price. He did not have any information that Wayne Pruitt didn't have. He had read the same newsletters, heard the same radio analysts, and understood the same market fundamentals. What he did differently was not prediction, it was prioritization. He decided that the certainty of $2.81 was worth more to him than the possibility of $3.50. Not because $3.50 wasn't real or wasn't possible, but because the cost of chasing it, the carrying costs, the interest, the liquidity pressure, was a real and measurable number, while the upside was not. He chose the certain thing over the possible thing. He chose cash in hand over potential on paper. That is not a brilliant market call. It's a balance sheet decision. And in 1983, most farmers were making marketing decisions when they should have been making balance sheet decisions. The summer of 1984 brought new crop corn pressure. Estimates for the 1984 harvest were large. The carryover from the 1983 crop, all that stored grain that had been sold in a rush through the spring, added to the supply picture. By July, new crop corn for December delivery was trading around $2.55. Some forecasters were talking $2.40 by year's end. They were close. December corn closed 1984 at $2.49. Dale planted his 1984 crop in May with no debt and a cash cushion from the 1983 harvest. He locked in a forward contract in July on 60% of his estimated production at $2.61. Not a home run, but above the market close. He did the same calculation he'd done the year before. He wrote down the interest rate. He wrote down the storage costs. He found the break-even. He sold into strength rather than hope. That fall, his neighbor to the south, a man who'd farmed 700 acres and had been regarded as one of the better operators in the county, did not make his scheduled loan payment. The bank gave him an extension. He was carrying the 1983 stored grain he'd sold at a loss into an operating note that now had to absorb the 1984 crop too. 2 years of adverse margins, compounding. By the spring of 1985, the farm crisis had a name. The newspapers were writing about it. The Farm Aid concert was coming. Banks in the region were starting to work through their problem loan portfolios quietly, and then not so quietly. Land prices were falling. Equipment values were falling. The structure that had been built on $4 corn and 12% annual land appreciation was coming apart. Dale watched it from a position of stillness, not comfort. Farming was never comfortable in those years. But stillness. He had no debt. He had not bet the operation on a price that hadn't come. He had taken the $2.81 and paid his bills and kept his options open. The neighbor to the south sold 320 acres in the winter of 1985 to service his debt. Not at the top of the land market, at the bottom. Because he had no choice. The bank had exhausted its patience, and the market had exhausted his margin. He went from 700 acres to 380 in one transaction, at prices that made the late 1970s look like a different country. Dale bought 80 of those acres. He paid cash. Below the 1979 peak. Nowhere close. But below even the deflated 1985 values in some cases, because he was the only bidder in the room who didn't need a loan to close. He did not gloat. He didn't talk about it. He drove past the coffee shop most mornings without stopping. There is a version of this story that turns Dale Renner into a prophet, into a man who saw what was coming and made a brilliant call. That is not this story. Dale will tell you himself, and he did years later when I asked him directly, that he did not see the collapse coming. He did not predict the dollar strength. He did not know about the export shortfall in advance. He was not smarter than the market. He just refused to pay for the privilege of guessing. That is what liquidity is. Not a special insight, not a prediction. A refusal to spend money on the cost of being uncertain. An insistence on keeping cash available so that when the world presents an option, a distressed land sale, a forward contract at a favorable basis, a spring planting season with no banker on the phone, you have the ability to act. The farmers who stored corn in the fall of 1983 were not stupid. They were optimistic. And their optimism had a mechanism: storage costs, interest accrual, operating loan pressure, that turned uncertainty into real loss before the market even moved against them. By the time corn dropped below $2.81, they had already lost money. The price decline was almost secondary. Dale took the cash. He paid his bills. He went into 1984 with zero leverage and full options. And when the 1985 land market presented what turned out to be a generational buying opportunity, he was one of the only people in his county positioned to take it. He bought that 80 acres at $1,100 per acre. By the time he retired, it was worth $6,800 per acre. But that's a different story for a different day. The point is simpler than that. Storage isn't free. Hope doesn't pay interest. The math didn't change between September and October or October and March. It just became harder to ignore. And the man who did the arithmetic first, who wrote down the daily carrying cost on a legal pad in late September and decided that certainty was worth more than upside, came out of the worst farm crisis in 50 years with his land, his credit, and his options intact. He took the cash, while everyone else waited. If this story made you think differently about how marketing decisions and cash flow decisions interact, about the difference between price risk and liquidity risk, leave a comment below. Tell me whether you would have held through that winter or sold in October. There's no wrong answer. It depends entirely on your balance sheet. That's the point. And if you want more stories about how farmers navigated the economic pressure of the 1970s and 80s, the ones who made it and the ones who didn't, and what separated them, subscribe. Because the math in those decisions is still relevant. It never really stopped being relevant. Dale Renner is in his late 70s now. He still farms 200 acres with his son. He has no debt. He has never had debt since October 1983. He did not time the market perfectly that fall. He just decided that $2.81 in hand was worth more than $3.50 in a bin, once you accounted for everything it would cost to get there. He was right. But he didn't know he was right until the spring. He just knew the math. That's the difference.